Well, I want to welcome everyone to today's program, Alaska Assets, a shareholders return report to Alaskans. This is our 15th annual program evaluating the performance of Alaska's assets. As shareholders of Alaska Inc., it's in our best interest as citizens of Alaska to be informed about how the assets of our state are performing. During the long debate that led to Alaska statehood, it was recognized that our state's population would likely never have the critical mass to finance government services solely through conventional means, namely taxation of individuals and businesses. In recognition of the need for Alaska to have the means to produce its own revenue, the state was granted 104 million acres of land and its attendant mineral rights. Now, not all of that land has been given to the state of Alaska, but that's a topic for another session. With the land and resource endowment, it was believed Alaska could build and sustain an economy and pay for necessary government services through effective management of its natural and financial resources. Today's program is an opportunity for us to review our asset portfolio and evaluate the annual progress of our Commonwealth. This program is made possible through the generous support of Northrim Bank. Thanks to Joe Shearhorn and his great team at Northrim for their continuing support of civic engagement and civil dialogue on important issues. And they're a great group of bankers as well. So let me now introduce today's panelists. Our first two panelists are well known to Alaskans. First is Mead Treadwell. Mead is a serial entrepreneur, the former Lieutenant Governor of Alaska, and an emeritus board member of Commonwealth North. Next is Craig Richards. Craig previously served as Attorney General for the state of Alaska during the Walker administration, and he continues to serve on the Board of Trustees for the Alaska Permanent Fund Corporation. We're also pleased to welcome Eileen Norcross. Eileen is Vice President of Policy Research and a Senior Research Fellow at the Mercatus Center at George Mason University. And joining her is Olivia Gonzalez, a PhD student in economics at George Mason University. I'll be back to more fully introduce Eileen and Olivia before they present. On behalf of Commonwealth North and our audience today, thank you and welcome to our panelists. Before the panelists begin, I want to extend my thanks to the Commonwealth North members who are online with us today. We're grateful for your participation in programs and study groups, as well as your commitment to citizen engagement and public policy. Commonwealth North was founded to provide a nonpartisan public policy forum to help Alaskans better understand some of the most complex issues impacting our state. For those of you who are not members, we always want to take a moment to thank you and invite you to also join Commonwealth North. Several Commonwealth North members have been instrumental over the past 15 years in developing and presenting this annual program. Our first presenter today is one of those people, Mead Treadwell. Again, Mead, welcome. The floor is yours. And please unmute yourself and I will turn it over to you.
Thank you, Scott. And thank you for taking on the presidency of Commonwealth North. You're doing a great job. As you alluded to, our agenda today is to take a high-level review of Alaska's assets based on our look at the state's CAFR document, the Comprehensive Annual Financial Report, in addition to other state reports and information provided by state agencies and enterprises. This is in a slide deck, which will be available to our audience to download and review. And my role is to give some historical context for this program and a top-line summary of our assets and economic health. And let me just say at the start, this is the 15th year of doing this. I don't know if Joe Beadle has been able to join us today, but I just want to give out a shout out to former Northrim Bank President Joe Beadle for also helping make this program and this tradition happen. And I'll go back to Commonwealth North's founders, the original co-chairs, our first and second governors, Bill Egan and Wally Hickel, who believed that this state, Governor Hickel used to say, we should have been a Commonwealth. But the fact is that we do have major assets. And as we go on, ongoing dilemma, dialogue, or even diatribe about the budget, our financial concerns are very real. But one reason for this program is to remind ourselves that we do indeed have a considerable asset portfolio. And I myself would be very happy to take my permanent fund dividend in land, but that's a different story. You know, Alaska has an odd history of profiting or growing through crisis, whether it was the construction boom following the '64 earthquake or the 1989 Exxon Valdez oil spill. Some of our most robust periods of growth have been born from disaster. And as federal recovery dollars are poised to perhaps erase our most immediate budget concerns, We must be mindful that the underlying financial conditions of our state remain unchanged. Recovery dollars might buy us time, but those dollars won't buy us a future. And with that in mind, let's press on. Just very quickly, the asset portfolio of the state is really in three categories: natural resource assets, financial assets, and enterprise assets. The natural resource assets are land, oil and gas, minerals, fish, critters, timber, tidelands, and more. Our financial assets, we have considerable monetary and investment assets, most notably the Alaska Permanent Fund, which is one of the top 20 sovereign wealth funds around the world. And our enterprise assets are revenue generating enterprises capitalized by the state of Alaska to engage in certain commercial or quasi-governmental activities, sometimes resulting in dividends to the state. Let's turn first to our land ownership as the basis of our natural resource assets. As you know, Alaska has 365 million acres. That's 1 million acres for every day of the year. The federal government retained ownership of about 222 million acres, or roughly 60% of the total, depicted here by the orange color. And Scott mentioned the state is endowed with 104 million acres, about 28% of the total land mass, shown here in blue. And Alaska's scale is so vast, it's impossible to scale to visibly detail the smaller increments in the last category. And the green color on our map aggregates municipal, native, and other private lands. 44 million acres of the state's 365 million acres, or 12%, was allocated to Alaska Native corporations as part of the Alaska Native Claims Settlement Act in 1971. And that leaves about 1% or less for everything else. And just one thing that has been changing on this map, as you know, Governor Dunleavy recently declared that the state was going to take over management of navigable waters in the state. That navigable waters number, the lands under navigable waters, probably add to our 103, 104 million acre statehood endowment. And we also do have a 3-mile stretch around the coastline, which is equal to the rest of America's coastline, as tidelands. And there's more and more activity and return to the Commonwealth from those tidelands. So I'll leave it at that. Let's take a look at the next slide, Alaska's economic health. Our economy has long been characterized as a three-legged stool: the oil, government, and everything else. And with 2020 and the economic outfall of the pandemic, there's no question the impact has been significant. We were barely out of a 4 or 5 year economic downturn. We were beginning to make modest gains in 2018 and 2019. And in 2020, gross state product fell by 4.9%, making Alaska one of the most heavily impacted states, ranking 9th among the 50 states for economic losses. We lost more than 22,000 jobs. Ironically, however, per capita personal income increased between 2019 and 2020, with the increase in transfer payments amounting for most of the growth. Let's go to the next slide. Alaska's countable assets, if we add up what we've been able to put a number on, and that might be money in our permanent fund, pension funds, it might be buildings we've paid for. Not all of our assets have a book value, and they're not reflected in the state's financial reports. I was asking yesterday if that includes our land, how much can I buy Denali for? But I was reminded it's mostly federal land. But let me note here that the numbers in this and the next few slides are the state fiscal year 2020, which ended on June 30th, 2020, or nearly 10 months ago. So it's a different time frame than the calendar figures shared on the previous slide, which was the economic, the GDP data. And for those assets that are countable, if you will, the valuation of the state's total assets saw a modest increase of 0.2 percentage point, totaling $102.6 billion. So that is total assets per Alaskan of 140,691. That's the top line. Let's go to the next slide. As we try to figure out what is our net position, if you take that $102 billion and you subtract the permanent fund balance, our net position is about 82.4 billion, just over, and that's down just over 1% from the prior year. Next slide. It's also prudent to consider that the Alaska Permanent Fund comprises a substantial portion of that net position. $65.3 billion is the is the corpus and the earnings account, I guess, of the permanent fund. And Craig will correct me if I'm wrong here. But our total net position trend is down to 1.2. And then just remember that first number that we had, which is that your net assets gross is over $100,000 per person. Let's go to the next slide. You can see that the revised estimate of the total net position, if you take out the permanent fund balance, reveals a significantly different view of where we stand. And we're not cognizant that there are substantial liabilities or potential liabilities that are not reflected in the net position calculation. Chief among these are unfunded pension obligations of about $29.5 billion and deferred maintenance of state assets, which is $1.5 to $2 billion. And looking at these numbers and also knowing there are probably 738,000 opinions and ideas about to do about them, I'm reminded of the Stockdale paradox. James Stockdale, you may remember, was a Vietnam POW, later a Medal of Honor recipient and also a vice presidential candidate. And when asked how he survived 8 brutal years as a prisoner of war, he said, "You must never confuse faith that you will prevail in the end, which you can never afford to lose, with the discipline to confront the most brutal facts of your current reality, whatever they might be. Disciplined realism, embracing what is, but doing so with a measure of optimism. That's what saw Stockdale through his worst days." I'm very glad the Mercatus Center is here to talk with us because we're not the only state with unfunded pension liabilities. Of course, our nation has a very large debt as well. But ladies and gentlemen, it's squall versus storm finish later. I think we are going to make it through, and let's see how well we do next year. Scott, back to you.
Thanks for your comments, Mead. I'm not going to introduce Craig Richards. Craig's on Alaska Permanent Fund, and the Permanent Fund has long been one of Alaska's best ideas. As we've navigated these past 5 or 6 years, the fund's importance has continued to grow, as have our sometimes conflicting expectations about the fund's structure and uses of its revenue. I'm pleased to call on Craig, a member of the Permanent Fund Corporation's Board of Trustees, to talk about this important asset and growing source of funding for our state. Craig, please unmute your microphone and I'll turn it over to you.
Great, thank you, Scott. And thank you other presenters and Commonwealth North for hosting and presenting. By any stretch of the imagination, the Permanent Fund on an asset basis has had a tremendous year. As reported in the fiscal 2020 CAFR, we are at $65.3 billion. Since just the CAFR came out, we are up to $78.7 billion. We're up 21% just since the CAFR came out, which puts the Permanent Fund up to date 31% in a year, which are great numbers. Now, obviously, a year ago was probably the low point of the stock market in a really long time. So performance returns always have to be considered against what time period you're using. And certainly the 1 year period right now represents a very dramatic run in markets, but also a very dramatic time period. But nonetheless, it's been a great banner year that's seen recovery from COVID and seen growth in the private and public equity portfolios that is really quite remarkable. Public equity in the past year is up about 60%. Our private equity portfolio, even with the 3-month lag that we use for reporting, is up 40%. So obviously part of that is rising tides lift all boats, but it's also not that as well. We're also doing quite well within the corporation. In particular, if you look at the $78 billion, one of the standout performers that is really contributing and has been over the last 5 to 8 year period is our private equity portfolio. It's currently about $13.2 billion. It's up, like I said, 40% in the last year, but it's up almost 21% over the last 5 years. So with that kind of performance, it's really differentiating the Permanent Fund from its peer group, which the benchmark for that particular asset allocation has been performing at about 12.8%. So the private equity portfolio is making us stand out in a very noticeable way from our peer group, which is generally considered to be and measured against pension plans in the lower 48. And staff continues to do a great job in other areas. In particular, we've taken an approach to the current risk of the equity markets, which is aggressive but conservative at the same time. We have about a 39% public equity allocation, and the CFO and staff have been basically trimming that as markets rise. They've been taking the gains and keeping us at that 30%, which is what has appeared to be a pretty effective strategy to take advantage of the rising markets, but also take some risk off the table as well. For inevitably, when we see maybe things come down a little bit, we won't be all in on the equity side, because in these kind of markets, your public equity portfolio can overwhelm everything else with growth if you don't rebalance fairly regularly. And the staff has just been wonderful about doing a very good job on that and maintaining the proper cash positions to do the rebalancings they need, as well as make their cash calls and fund the state government. So by any stretch, we've had a great year. And certainly when you're, up 31% in a year, it's easy to say, wow, we have $78 billion. That's a phenomenal number. We're not too far from maybe when the permanent fund can fund the whole government without taxes. But of course, that $78 billion represents, we can't expect that what we've done in the past is necessarily what we're going to do in the future. So before we get all too excited about where we're at with the fund, I think we need to take a little bit of time and recognize that not all is rosy. And in particular, what is not particularly rosy is the long-term projection for fund performance. Right now, our financial advisors, Callan, think that we're going to return about a total of 6.75% annually over the next 10 years, which after inflation means real returns of about 4.5%. Well, of course, the percentage of market value percentage established by the legislature to fund government and to fund the dividend is at about 5%, maybe a little less when you take into the lag associated with the formula. So really our projected long-term returns, given our benchmark performance and where the legislature has set the draw, is that it looks like the fund will grow, but it will probably grow just to keep up with inflation. It won't necessarily grow in much of a real sense if the projections turn out correct. So I just want to address that because I think it's important when you see these sort of large markets cycles. If we did 31% last year, how can we do 31% again? And what our advisors are telling us is that, the valuations are right now reflecting, of course, coming out of the negatives of COVID, both in terms of recovering some of the market gain that got lost a year ago, but also the optimism of coming out of that into what looks like sort of a little bit of a reopening, but also, just a ton of short-term stimulus at the federal level, which is, I think of it as sugar, not protein. It runs you for a while, but ultimately it can only drive you so far. And the issue we're having right now with our valuations, particularly the equities, is just that we're at our earnings ratios are historical highs for a lot of sectors. It's a challenging to see how we have real dynamic, continued outperforming equity markets over the next 5 to 10 years, given essentially a lot of the gains that you think you might have harvested out of equities already look like to be priced in. And you combine that with the fact that interest rates are at historical lows, there's not a lot of places for bonds to go either. Interest rates go up, bond prices will come down, but of course, as interest rates go up, that also means that equity valuations will start beginning to look a little less attractive, and those run the chance of going down again. So even if we don't have, a real negative market event in the medium term in the stock market, the forecasting is that the best predictions are we're probably not going to have over the next 10-year cycle real strong outperformance, and we're actually going to have pretty low performance in terms of the total portfolio around what we're taking out every year. So in summary, I'll just say that certainly it's been great at the permanent fund. Staff's running like a well-oiled machine. They've handled the markets perfectly with a $78 billion fund value. We're at asset valuations in our own portfolio that I didn't think I would see during my term. It was $54 billion when I was working for the state as Attorney General, and we were excited about that. That was a big number at the time. So at $78 billion, it looks great. But we are at the height of the cycle, and I think what I would just encourage is as we move forward that we continue really focusing on two things. The permanent fund and the staff needs to continue to focus on seeking alpha. We need to return above our benchmarks if we're going to grow the fund at all with the PMOV draw. That means the fund has to double commit and commit itself to excellence in all of its asset classes, not just private equity and the ones that are the sort of the sexy performers, but across the board we've got to squeeze out the extra little bit of return from every asset class. That's the only way the fund's going to grow on a real basis over time. And second, from a policy perspective, I just, speaking for myself, would encourage our policymakers to stay the long course and play the long game with the fund, that we continue to inflation proof, that, we continue to look at ways to get real growth into the fund. That requires external capital being put in. Royalties are only $300-400 million a year, trending down now going into the fund, whereas 10 years ago they were 1,000. So the external contribution of cash is becoming less and less meaningful, particularly relative to the growth in the size of the fund. So we need to continue to look and get more, more real investment into the fund. We need to make sure to keep to the rationalized percentage of market value percent. We think we can meet 5%, but it's at the high end of where we think the targets are. And, there's always risk to not being able to. And then we need to watch our ERA balance. Right now, the number is 17 billion, or about 13.9 billion after you remove the current commitments. So we need to make sure that number maintains robust enough that we can cover our state liabilities. And to summarize, I would just say that absolute great success in the last couple of years, but the surest way to continue that success is to focus on following a rules-based system for the fund and making sure we're doing all the things that we know as prudent investors and prudent managers of our uniquely Alaskan wealth assets that need to be done to ensure it maintains and even increases its generation to its value to the next generations. Well, thank you, Scott.
Thanks, Craig. I'd say that was overall a positive report with a pretty healthy dose of realism. But I've got confidence that you and your fellow permanent fund board members will work through the challenges in the future and preserve all that value. At least we're all counting on that. This year, we have called on the Mercatus Center at George Mason University to provide some context about the state of Alaska's financial condition. We are delighted to welcome Eileen Norcross, Vice President of Policy Research and a Senior Research Fellow at the Mercatus Center. Her research focuses on many facets of public finance, including specializing in state and local government finance. She is frequently cited in the media, published in academic journals, and has testified before Congress on these and other topics. And Eileen, I note that one of those topics is pension underfunding. Don't be surprised if we invite you back to speak on that topic. Joining Eileen is Olivia Gonzalez. Olivia is a PhD student at George Mason University. She also works as an economist at the U.S. Bureau of Economic Analysis. Her research interests include development economics, public finance, state and local policy, and regulatory analysis. She was a Mercatus Center Frederic Bastiat Fellow during the 2019-2020 academic year. Eileen, Olivia, welcome. Please unmute and share your remarks with our audience. The floor is yours.
Thank you very much. I'm going to start sharing my screen and begin with the presentation. All right. Thank you for inviting us today. It's a real pleasure to talk to you about Alaska's fiscal condition. I just want to preface these remarks by letting you know that Olivia and I will be updating this study with data for 2016 through 2020 with our co-authors at the Institute for the Study of Economic Growth at Wichita State. We're underway with that research right now. This presentation has data dating from our previous study, but we also updated a few of the metrics for today's conversation. So we have 5 areas of budgetary solvency in the fiscal rankings. We took these from the literature on how to measure the fiscal condition of state governments. Over the years, we've learned a few things about how well these metrics work, and that rankings are not as important as the metrics themselves, and that's something we continue to improve with the study. The 5 dimensions of solvency we look at are cash solvency. Does the state have enough cash to cover its short-term bills? Budgetary solvency. Does the state have sufficient revenue to cover expenses? Long-run solvency, which takes a look at long-run liabilities and assets. Service level solvency, in which we look at tax revenues and expenses relative to the state's income. And trust fund solvency, in which we break out the pensions, the unfunded pension obligations, and the other post-employment benefits, and look at them as a percent of the state's income. For the fiscal rankings, we focus on the government-wide financial statement, which is a broad overview of the government. We look at the statement of net position and the statement of activities. We do not look at the government-wide statements, fund statements for our metrics, but for today, we did create a metric for the purposes of this discussion to look at the permanent fund versus the general fund. From the most recent CAFR, you're probably familiar with the most recent analysis, the financial statement, which looks again at the state's overall position. The net position of the state of Alaska is $75.6 billion, 84% of which may not be spent, and its net position decreased in fiscal year 2020. According to the fund statement, governmental funds are at $70.1 billion, which is a $2 billion decrease from the previous year. The general funds of Alaska have $1.9 billion unassigned and $1.5 billion committed, and the Alaska Permanent Fund has $9.8 billion unassigned and $3.1 billion committed. The Alaska Permanent Fund principal is $52.4 billion. The general fund analysis from the CAFR, and again, this is coming from the CAFR itself. Just some background, the general fund is the chief operating fund of the state. One measure of liquidity that one could use to look at that general fund is to look at the unrestricted fund balance as a percent of the total fund expenditures. Unrestricted fund balance is 34.9% in FY 2020, and that indicates that the existing balance could cover about 3 months of spending. The state's general fund, again, decreased by $874 million in fiscal 2020. As was mentioned, federal revenues are a large portion of the total at nearly 60%. And in the past year, there's been a decline in royalties. So now to look at the fiscal ranking metrics, what Olivia and I have put together in our study. First, we look at cash solvency. Is there enough cash on hand for a state to cover its short-term bills? We look at 3 metrics. These are varying levels of liquidity, with the cash ratio being the most highly liquid to the current ratio, which is the least liquid, with assets that can be converted into cash within that fiscal year. And as a general benchmark, a cash ratio should be 1 or greater, and the current ratio should be 2 or greater. The US average in FY 2016, as you see, was about 2 for the cash ratio and 3.2 for the current ratio. For Alaska, the cash ratio, of course, far outstrips any of the nearest states due to Alaska's unique revenue structure. The Alaska's cash ratio was 17 in 2016, and its current ratio is 17.9. Alaska has 17 times the cash on hand to cover short-term bills. In 2016, this declined in 2020 to 12.3 for the cash ratio, and the current ratio declined to 13.23. And this is a chart, again, this is only through 2016. We are currently updating the other years for our study. But of course, you see the trends for Alaska's cash, which increased until we get to 2015, and then you see the decrease in 2016. Budgetary solvency, I think this is a very nice metric, which shows whether a state has enough revenues on hand to cover total expenses. Revenues should ideally match or slightly exceed expenses, with the US average being a little over 1 in 2016. The surplus or deficit per capita is really a metric of movement, not a total. And it's looking at the change in net assets. And it indicates a positive or negative direction in overall position. Nationally, you had a US average of negative 72 per capita in 2016. Alaska's budgetary solvency metrics in 2016 were quite poor, with revenues only covering 52% of expenses, and a surplus, a very negative position, surplus or deficit per capita of negative $6,946. The operating ratio improved slightly in 2020, but is still not great. It's 89% of revenues to cover expenses. And you're looking really for a metric of at least 1, if not greater than 1 for an operating ratio. And the surplus, really the deficit per capita, slightly less negative than in 2016, but still highly negative. Operating ratio trends quite dramatic. 2009 picks up for the recession. But again, this metric is pretty nice, a pretty nice snapshot of whether a state has a structural deficit. Some states like New Jersey have a pretty awful operating ratio where its structural deficit is obvious for a decade or more. Long run solvency, we now move to the long run focus. How large are liabilities relative to assets? We look at a net asset ratio, which is restricted and unrestricted net assets as a percent of total assets. The average in 2016 was negative 0.17, which tells us that liabilities are larger than assets on average in the states. The long-term liability ratio looks at non-current liabilities to total assets. That tells us that non-current liabilities are 63% of total assets. And long-term liabilities per capita are roughly $4,387 when we look at the US average. For Alaska, these are very different from the average, again, because of Alaska's unique structure. The net asset ratio in 2016 was 0.77, about the same in 2020. That picks up for the Alaska Permanent Fund. The long-term liability ratio is quite low, much lower than the average. Again, picking up for Alaska's unique structure, and the long-term liability per capita not as high as the national average. Alaska's asset trends, Olivia put this chart together, that just decomposes the unrestricted versus the restricted net assets. And it shows you that the restricted assets are a much larger proportion of total assets. Alaska's long-term liability trends. This is an interesting chart for what we hope to achieve with the study, which is to ask how good is the underlying data? How good are these reports in picking up for true fiscal condition? You'll see a GASB 68 there in 2015. What that represents is the recognition of pension liabilities on the books of state CAFRs. Previous to that, states were only picking up how much they paid towards their pension each year. So if they had paid the full amount, the full required amount, they would show no pension liability on the balance sheet. That measurement focus was changed in 2015. That's now picked up for in the states, and all the states show this uptick in unfunded pension liabilities. They've done the same thing for OPEB. That was introduced a few years after this study. So we anticipate that this is going to look a little worse going forward in the states as they begin to recognize the unfunded liability of those obligations on the balance sheet. Service level solvency, this dimension is very subjective. It really just looks at the size of taxes, revenues, and expenses relative to residents' income. I say it's subjective only because it really needs context. And we have found that there's not a lot of variation in the states. Most of them hover around the average. Total tax revenues to income is about 6%, revenues to income 13%, and expenses to state income 13%. But in Alaska, it's a much different story with the tax to income ratio of 0. Again, the revenue structure here comes into play. And what we see here is a gap opening up in 2016 between revenues and expenses, closing a little bit in 2020. So service level solvency, the graphs here tell that story. And then what you're going to see in 2016, again, is that gap opening up between revenues and expenses. What our ranking was picking up for, which we think we need to address based on this, is that you have fiscal slack in the sense that there's no tax revenue being picked up at all, which indicates you could technically raise taxes or find another tax source. But we think that the metrics are far more meaningful than the ranking in the case of Alaska. And this does indicate a worrying gap in between revenues and expenses in 2016. Of course, Alaska has a volatile source of revenue. Alaska's tax revenues were the most volatile among the states between 1998 and 2017, according to Pew. The issue, of course, is the high dependence on volatile revenue sources coming from natural resources. Severance taxes accounted for 67.3% of Alaska's tax revenue during this period. And again, the service level solvency and the budgetary solvency metrics show that gap opening up. Trust fund solvency, we created this because of the problems with measuring pensions and OPEB within the CAFR. In addition to the GASB lack of recognition of those liabilities in previous years, there is the ongoing controversy over how to measure unfunded pension, how to measure pension liabilities. We take the view that we should be using risk-free discount rates because they are guaranteed to be paid to state employees in many statutes and constitutions. So I've adjusted these numbers, and I'll explain both the actuarial value and the adjusted value. We do look at each pension system in the states, and we look at their unfunded pension liability, and we look at that as a proportion of state income. We do the same thing for the other post-employment benefits. And the average, when you adjust the discount rates and you measure those liabilities as though they are guaranteed to be paid, on average, they represent 43% of state income. Other post-employment benefits are a much smaller proportion, although they have generally the problem of being largely unfunded in most states. Alaska's story is that when you look at the two major pension plans, according to the actuarial reports, they have an unfunded liability of $6.37 billion and they're 70% funded. Once you go in and rediscount those liabilities according to 2016 interest rates, the unfunded liability increases to $37.3 billion and they're 28% funded. The OPEB liability is $8.4 billion in 2016, and unlike most states, it's actually relatively well funded at 55%. Many states are close to a pay-as-you-go basis for their OPEB liabilities. Alaska's trust fund solvency analysis, if you take that market value for the pension, not the actuarial, but the adjusted value based on those risk-free discount rates, pensions to income are 91% of state income, and the unfunded liability is 91% of state income. Which is much higher than the national average, and OPEB is 21% of state income. I'm going to hand the presentation over to Olivia now, who will discuss these slides on the permanent fund.
Thanks, Eileen, and thank you everyone for being here. The next couple of slides, I'm just going to go over a couple of different ways of looking at how the permanent fund affects different metrics in our rankings. So this first slide here is looking at the net asset ratio, which is part of the long run solvency dimension. And as you can see, we calculated the net asset ratio for 2020, both including the permanent fund and without it. And quite, as we would all expect, it falls from 76% to 16%. So that's just saying that the net asset ratio looks at the assets that are left over after state government has paid its debts relative to the government's total assets. So definitely comparing it to the 2016 national average, which Eileen mentioned was a negative 17%. So most states in 2016 were hurting in this area. So both including the permanent fund and without including it, Alaska is still doing much better than the national average. But as you can see, it drops significantly when you don't include the permanent fund assets. And then Eileen, can you move to the next slide?
Oh, I'm sorry. Yes.
Yeah, and then this is another way of looking at the same thing. But for here, we're looking at a cash solvency measure where we calculate the total assets relative to total liabilities. And I should say that in the previous slide, we were using the same financial statement, governmental-wide financial statement like what we use in our study, whereas here we're looking we calculated this new metric to look at the fund statements. And so we don't use this specific metric in our study, but we wanted to do this now to specifically more look at permanent fund. And as you can see, when we calculate this ratio for the general fund relative to the permanent fund, the asset to liability ratio situation improves a lot more when you look at the permanent fund. And yeah, next slide, yeah. And then I'm gonna hand it back over to Eileen, thanks.
So qualities of good metrics. Olivia has actually just completed a study on looking at these metrics and whether they have validity and do they make intuitive sense? Are they assessing the organization as a whole? Are they associated with other variables? Does a stronger economy strengthen a state's fiscal condition? And are the metrics correlated either within those 5 dimensions or are the different dimensions correlated? So we're doing some testing of these metrics and trying to improve the study as we do subsequent editions. The whole goal is really to operationalize the CAFR and to ask, is the data in here useful? Could it be made more useful? What the metrics can tell us: recession readiness. Does the state have sufficient cash to cover sudden downturns? Do revenues fail to match expenses over time? Is a structural deficit opening up? Do liabilities greatly exceed assets? Is the state relying extensively on debt over a long period of time? You see this in some of the worst performers. And then how large are expenses, taxes, and revenues relative to state income? Is spending sustainable? And how large are unfunded liabilities relative to resident income? What metrics cannot tell us, the metrics always need context. We can't tell you if the state can afford its obligations. You have to look more deeply at the economy. How does the state's tax structure affect the economy and revenue collection? How much is in the rainy day fund? We did produce another study in 2016 by Eric Elder, which indicated that if Alaska were to weather a severe recession, they would need about 1.8 billion in their rainy day fund. At that time, in 2015 data, they had 7.4 billion. They looked great. Today, they've got 2.5 billion. So it's a real drop from several years ago. They're still within the ballpark of weathering a severe recession if relying on the rainy day fund, but of course, that's something to keep an eye on. How's the economy doing? And then comparisons among states we find are somewhat limited. We have to consider the state's unique fiscal institutions, their constitutions, their statutes, their fiscal constitutions, so to speak, and how they treat these special funds, whether it be pension protections or whether it be a permanent fund or other rules. So where is Alaska headed? Olivia just wanted to conclude with this picture of oil prices, and we recognize how integrated oil prices are into the economy of Alaska and its fiscal condition, and it's something that needs to be considered in interpreting these metrics. We are happy to answer any questions. Thank you.
Great.
Well, thank you for your comments. I think the comments from Eileen and Olivia just really emphasize and underline the issues that we all know Alaska is facing right now. And the infusion of cash we've got from the federal government this year and last year has kind of hidden it from us, and probably means we're not going to turn a lot of attention to solving the problem. But it's there, it's structural. I appreciate your comments. Like I said, I think that really emphasized the issues that we're facing as a state. So now we'll turn over to the audience for any questions. Juanetta, I'll let you handle that.
All right. Thank you, Scott. All right. Well, thanks to all of our speakers. And again, for the audience, you can submit your questions at any time in the question and answer panel. And let me start with the first question that's always on everyone's mind is, will the slide decks be available? And yes, of course they will. We will be posting those on our website, and I'll be posting some links later in the chat window. Let me also open the opportunity for first questions to Scott, Mead, and Craig. If you have any questions for our guests or for each other, I'll include Eileen and Olivia in that. If you have questions for us as Alaskans in terms of some of the information and perspectives that we've shared. So can we start with questions from our panelists? Go ahead, Mead.
Yeah, I just want to ask about the pension fund. And you showed a slide that basically we were doing real well until the accounting rules changed. And you've heard the story on permanent fund performance. The pension funds don't do as well as the permanent fund, but they tend to follow the permanent funds investing fairly well. When I was lieutenant governor, the governor, worked to invest, I think, close to $1 billion additional in the fund. And we were one of the first states, and it did not involve Scott Walker style riots in the Capitol when we went from defined benefit to defined contribution. So are we really as badly off in comparison to other states on the pension fund that we've got? And what would you suggest given the asset and revenue picture that we have?
That's an excellent question. And to qualify the GASB, the change in the rules, what was going on there was simply a recognition within the CAFR of the unfunded liability that was already reported in other places. So it was, for our purposes, for the fiscal metrics, suddenly those metrics were picking up for something in the CAFR that wasn't fully reported in the past. So Alaska's pensions were still valued the same way consistently within actuarial reports and within other parts of the CAFR, but they were not included on the balance sheet. So they were not being picked up for in the balance sheet about state's fiscal position, which seems a little astonishing, but they did make that change, and that's why states suddenly saw a little bit of a dip on that dimension. Same thing's going to happen, well, already has happened with OPEB a few years after that report. As for Alaska's pension situation, yes, they closed the defined benefit plan in 2006. I did read that it's been reopened just this past week for some employees, I believe. I'm not that read that in preparation for this presentation, that there's some employees who want to rejoin the system. And I thought that was interesting because that's happened in the past with closed systems. One thing that's happened in Alaska that is not unlike Michigan, which also closed its plan, is sometimes when a plan is closed, policymakers don't make the full payment. And it leads to the liability to grow and for people to worry that the closed plan is somehow now more expensive than it was in the past. However, in a closed plan, you cannot add liabilities. The closed plan is simply not adding new employees. What does happen is policymakers have to recognize and pay down that liability, and they're not always consistent on that front. And that leads to the concern that a closed plan is somehow a drain on the state's finances. I would say that moving to a defined contribution plan is the better move, that closing the defined benefit plans and paying them down would in fact be the fiscally prudent thing to do. But much like Michigan, Alaska was not consistent in making that contribution over a certain period. And that's led to some people to worry that the closed plan has growing liabilities.
Thank you.
Okay. Craig, you had a question?
Certainly, to follow up on Lieutenant Governor's question, the slide that struck me, and I think maybe struck him as well, was when you move from measuring the unfunded liability from essentially the blended expected return based upon the asset allocation to using a risk-free rate, you went from an unfunded liability of 6.9 or 7 or whatever it was up to something in the 20s. And just from my perspective, literally the last firm fund meeting we had a long discussion with the risk folks around risk, and the greatest risk an endowment can take with defined obligations is not to take risk. So, because eventually you'll just eat through your principal and you won't be able to make your payment. So I was also struck by, it seemed a little unrealistic to think in terms of our liabilities, in terms of a risk-free rate, because we're not actually going to do that. So it's just a thought. I'd be curious as your response.
Yes, and that gets into, do you valuation versus the investment? What economists are arguing is that the pension fund should be valued based on risk-free rates because that they are guaranteed to be paid often in statute and constitution. That does not mean you have to invest solely in bonds. You think about the portfolio. Some economists make the case for an age matching portfolio to invest it in with the age composition of those in the plan, and as the participants age, to move to less risky investments. But the argument for risk-free discounting does come from economics, the thought there being that if you have a risk-free cash flow, it should be discounted with reference to its closest analog in the market, which would be bonds. And they are extremely low right now. In fact, I did go in and rediscount it for 2020, and it was astonishingly high because interest rates are negative. So we had, yes, it's an economic value, and it doesn't change the value of the liability itself. It's simply a recognition of the present value of the liability as though it was guaranteed to be paid.
Thank you for that. Your comments on this topic remind me of a characterization from our director of our Institute of Social and Economic Research, which is the valuation of these unfunded pension liabilities is something of a dark art, and that's his characterization. But I'm wondering, in terms of monitoring state performance and activity on this metric moving forward, what should the average citizen or groups such as Commonwealth North who monitor these topics look at? What would you be looking for on the in terms of state behavior and on the balance sheet for moving forward?
For pensions in particular, or the state in general? Pensions, I would say, make the payments. States that have run into the most problems have, I would say, used favorable assumptions within their actuarial reports to keep that payment as low as possible. And we even see it in some of the private sector now, some games with the accounting going on. And I just say avoid those things. Short-term gains in terms of not making the full payment means long-term risk for the pension. So fiscal discipline on that front, I think, is key to a healthy pension plan.
Thank you. Craig, I'm wondering if you could speak to something that I've heard you say as well, which is the dichotomy that we're in with a period of extremely high valuation but low interest rates, and what the challenges that might present for the management and governance of the permanent fund moving forward.
Certainly, and it's the same for the retirement boards as well, that the reason that we've done so well in the last year is that stock prices and private equity prices have gone up due to optimism about the economy as we recover from COVID. But in doing so, those valuations require ever and ever higher expectations of earnings to justify. And as we reach asset valuations in our equities like we're seeing right now, it becomes very difficult in the long term to see how you can have a lot more optimism in most stocks, unless, something really fundamentally different happens in the economy than what we're used to in the next few years. So we're sort of at the top of where you can expect a lot of equity valuations to be, which means it's going to take a long time for earnings to rise to sort of match those, particularly if interest rates start to come up, which just creates an environment where our advisors at the fund, and I'm sure at the ARM board it's the same thing, they're telling them that it's not a period to be very optimistic about, long going, continuing robust returns in the equity markets. We've had a heck of a pop the last year, but the expectation is that will be much more muted in slow growth for, a more medium, longer term period.
All right, well, our audience is being very quiet. So as panelists, you've either answered all of their questions or they're being uncharacteristically shy. So I'm going to make one last call, and it looks like Mead has a question. Mead.
Yeah, I'd like to ask our experts from the Mercatus Center a question you may not have studied, but how are the states doing generally in comparison to the federal government? If you took the same analysis that you just did to our national debt right now, which is over 28 trillion and greater than our GDP, what would you say?
I'd say the main difference with the states is that the federal government can get away with this, but the states have a hard budget constraint at some point. The amount of spending that's going on is mind-boggling at the federal level, and there will be a price to pay eventually, I think, for that. But given that the states have a hard budget constraint, they cannot print money. Where are they going to go if they're potentially ask for a bailout? And that's concerning to me because if fiscal federalism is to work in a healthy way, there has to be a hard budget constraint for the states. They cannot get bailed out continually. That weakens fiscal discipline, and then they don't make sound budgetary choices, and they spend beyond their means essentially. So there are real implications for ongoing bailouts in terms of state fiscal prudence and even the operation of fiscal federalism. Some states have behaved terribly over the past decade and a half or so in terms of their fiscal discipline and made very poor choices. And some states have been prudent. So again, it's also an issue of fairness, I think, on some level, where some states are being bailed out of poor choices in terms of fiscal prudence in Illinois and in New Jersey and a few other places. So that would be my main worry. How long can this go on, and what are the implications of bailouts?
And we had, I think you showed, we had something like 60% of our budget came from the federal government. Is that high or low in comparison to other states?
That's high. Yes. I think it's close. I want to say it's double, but it's high.
I think it's in per capita terms, when you calculate it in that way, it is actually the highest when it comes to that metric across the states. Yeah, it's pretty significant.
Yeah.
Okay. So we are very dependent on federal solvency ourselves.
Correct. And in most states, you're going to see it in Medicaid. That's usually where it shows up.
And to add to that, one of the bellwethers that many folks involved in economic development and community development and economics in general are sounding the alarm bells for is the declining population in Alaska. So all of these metrics are continuing to rise because of that as well.
Yeah, this is Craig. I mean, we get our revenue from the federal government, from stock market returns and commodities that are driven by oil prices. So, try to capture that lightning, right? How do you forecast and predict that 20 years in the future?
A footnote on that. I represent Alaska in compact for a balanced budget amendment federally. And we're talking to a lot of state officials right now about their dependence on federal spending and whether or not federal solvency is going to happen. So, or insolvency is going to happen. And yes, they can print money and we can't, but we're depending on them to do that. And we're watching it happen right now. So anyway, this has been tremendous. Thank you.
Yeah. Okay, well, we're coming up on 1 o'clock, so and I don't see any other questions from the audience, and I'll hand it back to Scott. Scott?
Thanks, Vanetta. Well, Mead Treadwell, Craig Richards, Eileen Norcross, Olivia Gonzalez, thank you for joining us today. Thank you for your presentations and the discussion about Alaska's assets and overall financial condition. Definitely a sobering story. I want to also thank our sponsor, Northrim Bank, for their ongoing support of the annual Alaska Assets Program. Through programs such as this, we can continue to engage Alaskans to consider our state's fiscal condition and the value and return on state assets, all of which serve as the foundation for our future. And thank you to our members and friends for joining us today. Again, if you are not a member, I encourage you to become a member of Commonwealth North at www.commonwealthnorth.org. We invite you to join us for our next program, Carbon Dividends, a bipartisan proposal to achieve net zero, on May 12th at noon. Our speakers will be former Congressman from Philadelphia, Ryan Costello, and Kevin Sweeney, both of whom serve as strategic advisors to Americans for Carbon Dividends. And joining them will be Catriona Rourke, Vice President Policy, Climate Leadership Council. Please join us for a timely program on an important topic. We stand adjourned. Thank you.